Hello and welcome to the BAFT webinar, Basel III Overview, Where Things Stand Now. The proposed changes to the U.S. regulatory capital requirements represent a major overhaul with implications for institutions of all sizes. In March 2026, the U.S. banking regulators released a new set of proposed rules that could affect capital treatment, operational risk requirements, and the way banks manage a range of exposures, including many trade-related items. Today, we will have a practical discussion of the proposals, the key issues raised in BAFT's response to the regulators, and the potential implications for your institution. Our experts will provide insight into the changes, answer your questions from participants, and discuss what implementation may look like in practice. So we're going to have a couple of housekeeping items first. And Matt, if you could roll those slides. So let's go to the next one. So just to remind everybody, everyone is muted to reduce noise or distractions. Video is turned off for everyone except the speakers, and the webinar is being recorded and will be posted after the session. Okay, next. So the way to submit your questions, we prefer that you go down to the to the bar at the bottom of the page where you have the more with the three little buttons. Click on that, and you will get one of the pop-ups in the middle of the second row is Q&A. That's our preferred way for people to pose questions. If you can't do that and you then use the raise hand function, we would absolutely prefer people not use the chat string because we can't monitor three different platforms at once. So best way is to use the Q&A, go to the more button, the three little dots, click on that, and go to the Q&A and pose your question that way. Secondly would be raising your hand, okay? And then Matt, third one? Okay, so our webinar today is going to be in three parts. Part one will be a presentation of the specifics of Basel as it is structured today. Our speakers on this phase are Matt Bassans and Rebecca Fruchtman of Meyer Brown. Matt is a regulatory partner in Meyer Brown's financial services practice. He counsels financial institutions on complex risk management and governance issues, including balance sheet optimization, transaction, and advanced regulatory reporting. Rebecca Fruchtman is counsel in Meyer Brown's Chicago office and a member of the banking and finance practice. Her practice focuses on the global trade finance space, including supply chain finance, open account, LCs, structured LCs, and risk distribution. And Rebecca also is co-chair of BAFT's Supply Chain Finance Committee. So thanks, and over to you two.
Great. Thank you, Craig. We have a deck here, and we're not going to belabor the entire deck, but we did want to put into context where BAFT's comment letter came from for what Andy will be discussing. And I think one of the points that I've had to make a few times is that capital requirements have been with us a long time, since the 1980s. There was a proposal in 2023 to revise them for banks, which I think many of you are probably familiar with. BAFT submitted a comment letter on that. And that proposal would have greatly increased capital requirements for U.S. banks. That proposal was abandoned both in the face of strong industry opposition as well as a change in presidential administration. The current administration has indicated that they want to either keep capital requirements the same or reduce them a little bit. And that is what led to the 2026 proposal. It would primarily affect the 40 to 50 largest banks in the U.S. There are some benefits for smaller banks out there, but again, the target is the 40 to 50 largest banks. The comment period closed about a month ago, and again, BAFT submitted a very good comment letter, I think, on it. Again, major props to Andy and Craig for shepherding that process. And the reason why is that when you look at the banks who are impacted by the proposal, you'll probably notice a lot of names that are familiar for BAFT products, but also a lot who aren't. And it's important to remember that this proposal affects all of these banks. And so while trade finance and supply chain finance and other trade products are incredibly important to the economy, they're certainly what BAFT members make their living on. They are a relatively small part of many of these very large banks. And so most of the changes in the proposals do not affect trade finance in any way. And in fact, many of the items that Andy will go over as key to our letter for BAFT, they are areas where I think the regulators just didn't give attention because they aren't as keyed in to the ways in which capital rules affect the trade finance industry. That Rebecca will come back to this a couple of times. That when you're looking at the rules, you almost have to translate them because nowhere in them do they mention things like factoring, things like flow arrangements, and they just talk about it in terms of generic products. And so I'll move along right here that, for example, there is only a bucket for non-real estate corporate loans. That picks up everything. And even going forward, there would only be those buckets. So there is not a risk weight that's specific to trade finance products or subsets of them, that they kind of get lumped in with all corporate exposures. And so the smaller banks, which are in the middle of the column, would get a relatively small benefit under the new proposal. And then the 10 largest banks, that's the ones on the right side. And Rebecca, I don't know if you want to chime in here.
I wanted to talk about the tenor for trade instruments. That they're self-liquidating trade-related contingent items. I mean, I think that is as long as they're less than 90 days, they're not going to carry a risk weight. And I just wanted to mention that the BAFT advocacy letter is trying to expand that brief 90-day period to 6 months, and to include both funded and unfunded trade-related exposures, and that would better align with European regulatory requirements.
Yes, thank you. One change that I think will be somewhat welcome for the 10 largest banks in the US is this idea that if the obligor is investment grade, and this does not mean they have to have a Moody's rating, this means the bank determines that they are investment grade, then they get a much lower 65% risk weight. And for some of the mid-sized corporate obligors on trade finance products, this should be a benefit. We have asked that this be extended to the smaller banks, recognizing that there are banks that are smaller than the top 10 who can do this kind of credit underwriting. I don't know if we'll get it. Again, I'm hopeful we will get it. But this is an area of where the rules benefit people who are able to make these investment grade determinations. Another area, and Rebecca, I don't know if you want to talk about this, where we had a big win.
Yeah, there was a win in terms of the shift from the 2023 proposal to the current proposal. The 2023 proposal, it would have imposed this cross default rule. And you take supply chain finance programs where the buyer might be defaulted. In the 2023 proposal, that buyer, if it in a supply chain finance program, if it had any credit obligation, not just to the bank that's running that supply chain program, but any creditor, if it's 90 days past due or a non-accrual status, then that would have a punitive risk weight attached to it, which was just unbelievable, because how can a bank kind of track what's going on all the time with not just indebtedness owed to it, but to all of its customers, the buyers, creditors out there. So that's gone away. However, there's still greater in the current proposal. There's still greater risk weighting for defaulted exposures if settlement of a payment happens 90 days after the maturity date, and the BAFT group thinks this is too long, and the advocacy letter is saying, look, there are many cases where settlement may not have matched after 90 days, and it's not due to credit reasons. There can be a dispute going on between the buyer or the supplier, a commercial dispute, or it could even be just purely operational reasons, like a mismatch of settlement amounts and the like. And so the advocacy letter argues that any operational delays should really be carved out of this additional risk weighting.
And that's great. I mean, that was a big win.
It's a big win. Yeah.
Where we still have a lot of work to do is with these off-balance sheet commitments, though. This is kind of the credit lines that people are extended, because right now most trade finance products live in this 50% bucket over here, and the proposal would kind of make life more difficult for most of the other buckets. And Andy will talk more about this on his segment, but we really talk about there should be some changes in duration to provide benefits for longer term exposures. There should be more gradations for recognizing lower risk weighting factors. Rebecca, I don't know if you wanted to say some here.
Yeah, this is what I wanted to point out again: the self-liquidating trade-related contingent items, which has that risk weight at 20%. So that the ceiling on that is, as I said, currently 3 months, and because 6 months, most trade tenors are 6 months. Some may go to a year, but many or most are 6 months. So they want to really see that extended out to 6 months.
Yeah, so this area is one where I think Andy, like probably what half of our letter touches on this this slide. Oh, part of it is the expansion of what is a commitment that would have a capital charge to it. And it is expanded to things including advised lines, other contractual arrangements that might fall short of being legally binding, but they still have a expectation or a practice. And so that's an area where the regulators are saying, well, we would like to see a risk weight put in there. I am hopeful that we will keep the definition of a commitment where it is now, so that it is not a punitive drag. This is substantial for things like credit cards and other types of warehouse lines and revolving facilities. So we are in good company with the rest of the banking industry on saying this is a bad idea.
This one is a really big one. Were it to pass and go into effect, this would be terrible for trade finance. This is where the advocacy letter, we really focused on this expanded definition of commitment. I mean, just look at it. It's very broad. the proposed definition, any contractual arrangement under which a banking organization and an obligor agree to terms applicable to one or more future extensions of credit, purchases of assets, issuances of credit substitutes, whether or not such arrangement is unconditionally cancelable. So this really captures an infinite universe of finance-related contracts, where the banks have, they have contracts in place where they're with their customers, where they agree that they're going to extend credit or they're going to buy assets at some future point in time, albeit in their sole discretion. It is at their sole discretion. So this could potentially impact almost every trade finance program you can think of. I'm just going to name a few: supply chain finance, receivables financing, also called factoring, standby and documentary letter of credit facilities, and funding participations of trade assets between banks. Even though all of these that I just mentioned are oftentimes, if not always, uncommitted, they're still potentially in scope. And then on top of that, remember that the expanded risk-based approach, it requires banking organizations that are in scope to hold 10% capital against any of these programs. And it's these very, category 1 banks and also banks that opt into the expanded risk-based approach that are the very ones that have successfully offered and dominate the market in supply chain finance and other programs. Are also very robust issuers of letters of credit and the like. I'm going to focus on how the definition of commitment impacts supply chain finance programs. First of all, I want to make sure that everybody who's listening in understands what I mean by a supply chain finance program. It's also called reverse factoring. So in this structure, if you're a bank, your customer is the buyer of some goods and services, and you are contracting with them on one side, and you're contracting with their suppliers on the other side to buy receivables or bills of exchange that your customer, the buyer, has approved for payment. And generally speaking, this is going to enable your customer to get extended payment terms. And then on the bright side for the suppliers, they get paid earlier than the maturity date, quite frequently on the invoice that gives rise to the receivable or the bill of exchange. And at the end of the day, it's a liquidity solution that enhances cash flows for both the buyer and its suppliers. And then as the funding bank, on purchasing receivables or on purchasing bills, you're paying a purchase price that's based on the time value of money and a little bank profit or fee. And some supply chain finance structures also include situations where the bank just acts as a purchasing, as a payment agent for the buyer. And so the supplier gets paid on the relevant invoice and the invoices are extinguished. When we think about the extinguishment model of supply chain, when we think about this extinguishment model, it is also in scope. It's also a type of supply chain finance product. Ideally, these programs should fall outside the parameters of the proposed definition. Like I said earlier, they're almost always not committed. But also, there's not in the four corners of the documentation, which is the buyer agreement or payment services agreement on one side and the receivables purchase or draft purchase agreement on the other, you're not going to see any kind of credit limit in there. But it's still... there's no dollar amount that you might see in the four corners of the document, but normally a funding bank is going to separately have on the side and in their own books and records a credit line or dollar limit. But the silence of the documents itself is an argument that this type of program should fall outside of the definition of commitment. But, I think that that definition is so broad that nonetheless, it's that these types of programs are going to be encompasses by the definition. However, our BAFT advocacy letter argued that they should be deliberately excluded from the scope because they're low-risk programs. And it's kind of, ridiculous to hold any upfront capital. And also, as I pointed out earlier, the Category 1 and other banks that are running these programs have run them for many years. They've been successful, and there's low or no default rates in general in connection with these programs. They're also extremely popular, and they boost U.S. and global trade. I've explained how they enhance liquidity. They also can give buyers very favorable off-balance sheet treatment. This was all emphasized in the BAFT advocacy letter. And again, we've been emphasizing in this presentation and also in the BAFT advocacy letter, like, look, the tenors are generally short, and they're self-liquidating in nature. And the pricing is really attractive. Given that these programs are uncommitted, when corporates are looking for financing to have, a lower financing cost and be able to onboard their suppliers into one of these programs is attractive. And these programs involve hundreds of thousands of U.S. companies. And they do not serve as a source of leverage because of the fact that the tenors are by and large pretty short. So in short, we argued in the advocacy letter that these programs are of central importance to U.S. trade because of the liquidity and the efficiencies that they create for global trade transactions and U.S. domestic transactions. But they're not big revenue generators for banks. And so if you're asking for a 10% set aside, that kind of dampens the enthusiasm for banks to want to offer these products, and also they can become less available as a financing source for corporates who might otherwise seek to start up one of these programs. And as I think everybody knows, First Brands and its ilk have had some dampening effect on these products, kind of generally. And so there's concern, as was expressed in the advocacy letter, that the economics here are very fragile, and you could see, a potential wind down of these programs, or they could become more expensive. And none of this is a good thing. So the other kind of key point is the Category 1 banks that are running these programs, they're sophisticated. They're discerning about customer choice. They're, selecting customers. They're monitoring customers. And so that is a really good contributor to the low default rates in these programs. Some of these programs have been in place now for 20 years. And sort of in summary, we urge the letter urged the regulators to maintain the status quo of the treatment and to retain the current more narrow definition of commitment in order to support the needs of corporates without increasing the strain and the risk on banks. Particularly the banks that have been doing so well with these programs over many years.
Credit insurance, I think, is another one, Rebecca.
Yeah. So the advocacy letter also addresses the fact that it's unfortunate that the current proposal would remove the recognition of credit insurance as facilitating a risk transfer. This is not the case in jurisdictions like the EU and the UK, which get the full benefit of risk transfer when they use credit insurance to underpin supply chain finance transactions or receivables finance or trade related loans, however, credit insurance is being used in the trade finance context. And that really puts U.S. Banking organizations at a competitive disadvantage. I think this is one, and it leads to relatively higher financing costs for U.S. companies related to their competitors in Europe. But I think this is one, Matt, where we don't think there's going to be any traction. We don't think that there's going to be any that there's going to be any change on the credit insurance front. That it's not going to be able to be used as a risk transfer device.
I agree. It's unfortunate, but that seems to be the direction that they're going in. So market risk capital is an area where I think you've seen most of the headlines. This is one that actually Jamie Dimon complained publicly about, but it has no impact on trade finance. So while it is a really hot button topic, we don't really need to talk about it here. Operational risk capital is one where the proposal generally did a much better job. It narrowed the scope of it. It narrowed the banks that were subject to it. But as Rebecca will talk about, the capital charges are not, the best for trade finance. And just so you can distinguish, what we've been talking about to date in the program is credit risk. That's the risk of a borrower default. Operational risk is the risk that the bank loses money due to something bad happening, like a robbery or a natural disaster. And so there's not really a precise way to measure that because, we can't predict how many robberies a bank will have. And so the regulators are proposing proxies that are based on the amount of interest income, non-interest revenue and expenses. And they feel that the larger those numbers are, the more likely a bank is to have bad things happen to it. But Rebecca, do you want to comment on the impact here?
Sure. Yeah, I guess the theory of the regulators, Matt, would you be fair to say that fee-based income creates dependency by the banks so that there's need to be risk weighting to capture the risk of loss if the bank were to lose the revenue stream, like you were saying, if there was some kind of black swan event or inadequate internal controls?
That's the ideal, though I don't know how much evidence there is behind that. That's what the regulators' view is, but again, I'm not sure how much evidence they have to support it.
Yeah, so it makes no sense if you're looking at letter of credit related fees that would be impacted by this, why there would be like some sort of huge loss or huge hit if that fee income were lost. So it's not really properly sized to that risk. As I understand it, there if it's interest related income, which would certainly be the case if you're issuing a letter of credit, you're confirming a letter of credit, or even with a cancellation fee, that is an interest-based fee, and you can't net there's an inability to net under the current proposal, so that could have some impact, but it really makes no sense. And again, the BAFT advocacy letter addresses this. It's a tiny percentage of a financial institution's overall fee. And losses are, going to be almost zero on these types of products. These fees are not, they're not profit centers to banks. LCs are just so marginal, and they're designed to cover operational costs. Processing paper, managing the process, and importantly, dealing with the compliance and infrastructure, sanction screening, and the like. And so this is kind of ironic because these very fees, are applied and probably used so that the bank can defray the cost of whatever the LC issuance is in order to comply with Fed, OCC, and OFAC mandates. So it seems inappropriate for these types of fees.
The other changes are not going to be relevant to BAFT members. They're things, like losses on available for sale securities, mortgage servicing rights. And so really my concluding thought here is that this is really an important advocacy issue, but I think we're going to fight for attention just among all of the different parts of the market. So with that, maybe, Rebecca, I don't know if you want to have any thoughts or if we want to pass it over to Andy.
Yeah, I'll pass it to Andy in a minute. I just want to say it's, on this commitment point, we're really crossing our fingers that the status quo will be retained. And I think you said, Matt, that the Trump administration, like it was kind of a last minute thing, and the Trump administration, it maybe kind of was slipped by them. And so that's maybe now that they're looking at it. And yeah, we can maybe hope that the status quo will be maintained on that.
Thank you, Matt and Rebecca. That was fabulous. And we're going to shift to part two now. This is an overview of the response from BAFT on behalf of the transaction banking industry to the U.S. regulators. Our speaker on this phase will be Andy Price, BAFT's Vice President for International Policy, where he engages in advocacy on behalf of international transaction bankers across the industry before various international standard-setting bodies such as Basel, the Financial Stability Board, and the Financial Action Task Force, and others. Thank you. Andy, over to you.
Yeah, thank you, and good morning, afternoon, evening, whatever your situation may be. Pleasure to be here, and thank you for being here today. Really appreciate it, and I want to thank our panelists, including Svetlana coming up, who have just been wonderful in helping BAFT shape our response to the U.S. proposal. We also had a larger working group where we tried to get banks of all situation sizes who were also incredibly instrumental in helping us put our response together. So I wanted to say thank you for that too. And Rebecca and Matt have done a wonderful job kind of hitting some of the highlights of our letter, and so I'm kind of adjusting my comments here to not duplicate that. But I want to take just kind of a second to step back. BAFT is a global trade association, and so we've been involved in Basel for a long time, and with the implementation kind of around the world, and so I kind of want to take a step back really quickly here. I'm going to get to the details of our comment letter, are the bulk of my comments today. But I want to do that because I think it gives some perspective on some of the arguments that we're going to make, particularly when we're looking at what other jurisdictions have done, and then the impact on trade. And I also want to say we're one of the few. I haven't made my way through all the comment letters yet. I kind of went into a blackout phase after we filed our comment letter, but we're really one of the only organizations that filed comments specifically on trade and arguing how the changes to the capital standards are going to affect trade, and I think that's very important. And so our challenge, and Matt alluded to this, getting that elevated so that the policymakers understand the consequences of what they've done is a lot of where we're going to focus our advocacy area. If we can be successful in that, I think some of our arguments will win the day. But just remember kind of how we got here. The Basel III framework was finalized back in 2018, and since then the rest of the world has been going through what I call national level implementation, where countries are now adopting that final framework that was adopted back then. You had reforms post financial crisis 2008. and then the whole final Basel III framework was finished in 2018. And so the UK has gone through the process. The EU, CRD6, and many other places around the world have done that. The U.S., as Matt alluded, we had our first proposal that met with a lot of industry opposition, and we now have our re-proposal that overall is a lot more favorable. We have our issues on trade, but I think is a clear improvement over the first round of proposal. But that I want to point that out. That national implementation, looking at the international standard, when you get to the national level, it's a political process. It has to be adopted by that particular country, and in some places through their legislative branch. And here we're a rulemaking process where you have political appointees sitting at the head, and that's kind of important to pay attention to, because it shapes how the rule is implemented. And what you're seeing now is a lot of posturing among the countries who are kind of looking at each other, seeing what each other are done. In the UK, we saw some delays there. The EU just announced the other day they're holding off on some of their market risk capital approaches. There's a report coming out on Friday on the competitiveness in the banking sector that are going to propose some changes to what they've already adopted in CRD6. And part of that is, no particular country wants to let another country get a significant advantage over their approach. And so you're seeing deviations from the international standard that are being adopted, and we're seeing that in the United States too. And in particular, it's very interesting if you look when the Federal Reserve Board had their meeting and the three agencies rolled out the proposal. Go and read the statements by Michelle Bowman. She was openly hostile to the Basel Committee's proposal, saying, "Hey, we're going to adopt what the United States needs for to reflect our way of how we regulate banks, our risks. We're going to tailor the risk appropriate to the United States." And at that, I mean, I mean, in many instances, just said the Basel Committee is not going to dictate what we do. There are a lot of deviations from the standard in our rule. There's a lot of places where it follows it too. So I'm not saying it's a pure abandonment of it, but I point that out because I think when I say it's a political process, you'll see some of the difference in the approach that the political people may take, and then when you get down to the bureaucratic level and the regulators, a lot of them have been here a long time. They were involved in establishing the Basel framework. You may see some tension there, and I think it's within that area. I think that there may be some pathways for us to kind of win the arguments on perhaps why there should be some slight deviations from the international standard. You should tailor appropriate for the risk. Those arguments may win the day, recognizing that distinction that goes on there. So I kind of want to put it in that context, and that's where we are kind of with this rulemaking process. And just two other notes before I get to the comment letter, because I know you're going to ask me is when do I think this rule is going to be finalized? And this is Andy's prediction market here on this. But my guess is they're likely going to try and do this by the end of the year, after the election, before the new Congress gets in. And I say that because I think that's kind of the sweet spot for them to do it and not get a ton of backlash. If new Congress come in, they may have their own views on how things want to be and put their stamp on it. I think that kind of makes a nice place for them to do it. So that's kind of my guess. I've never won the lottery, so I'm frequently wrong on many guesses. But I just kind of wanted to put that out there as far as my takes and when I think it's going to be finalized, which is also how I'm kind of approaching our advocacy on this issue, to make sure we make our points between now and when I think they may finalize it too. The other wild card in there is Kevin Warsh, just to send it to the chair of the Federal Reserve, and I'm trying to read the tea leaves on it. Remember, this is a 3 agency kind of agreed upon approach. So kind of watching out to see what kind of stamp he may or may not want to put on the, what this rule looks like in the final issue. So let me turn now to the and keep some of those points in mind, because I'm going to touch back on them when we come to some of the points in the rule. The biggest issue, I think, and Rebecca and Matt have already kind of touched on it, was the issue of the definition of commitments. It's the definition they're putting in there is largely based on the Basel definition. The problem is when it's being put into the U.S. Framework, the definition is now capturing a lot of products that are not currently captured under the way it's defined currently. And so what that means, the expanded risk-based approach is going to require banks to hold 10% capital against unconditionally cancelable commitments. Rebecca has already kind of touched on this. But it could capture receivables, financing, uncommitted standby letters of credit, participation in the trade asset between bank, all kinds of products may now have an extra charge on there if the new definition is attached, which is not currently being charged on the definition. So our advocacy on that letter was to maintain the current definition. And the advocacy letter, we've spent a long time explaining to them how supply chain finance programs work, the nature of it, and our obligations at various stages along the way, urging them to maintain that current definition so that you won't get that additional charge on the various products. I'm happy to say the ABA BPI letter too also took the approach about maintaining that definition of commitments. We also pointed out that in the UK, they're not necessarily wrapping in those extra products as well. The EU, I've been told, is kind of a gray area, is the answer I've gotten from actually several people. They've just kind of said, not quite sure yet, but tend to think that it's not going to get wrapped in there. And I'm interested to see some of the proposals that are coming on Friday, whether or not they clarify that up or not. So we're pointing to some of the other countries and what they've done and not capturing that charges, and then urging them, making that argument that I think will relate to the political point that you want to keep your banks competitive with what other countries have done. And so the issue of commitments is we're urging them to maintain that definition and pushing hard. I think that's likely the biggest area that's going to have the greatest effect among trade finance. And so let me turn to some of the other issues. The credit risk transfer issue about being able to use insurance to offset the potential charges that you're getting to capital on there. I agree. I think it's going to be I'm not sure the regulators are going to get there. The thing, though, that I'm seeing, though, that perhaps gives us some hope is a lot of industry, not only from the insurance industry, but in a lot of the banks. But we've even seen letters from Congress going over now to the regulators, urging them to look at that. I think Andy Barr out of Kentucky and Jim Himes out of Connecticut signed a letter going over. So you're seeing a lot more public advocacy go on this particular issue. Which, if I'm oddsing it, I'm still not. I'm still not overly optimistic, but but that is at least a sign that perhaps some headway is being made there. The credit conversion factor is another one too. We urge them, in the Basel framework, when they calibrated that rate at 50%, that was done back in the 80s, and so we have urged them to use, now that they have a lot of more data at their disposal, to look at that and to actually calibrate it using more current data. And so we propose them to go to a 20% rate on that, as opposed to a 50%, to reflect the true risk of the various trade products that we offer. So that was in our comment letter as well. The risk weights for bank exposures, they've done something. I guess it's interesting. But they proposed a tier rate. Usually once you're well capitalized, you get the benefits of everything. But they've created a preferential rate for now even highly capitalized, so above well capitalized, and there's a tier in there. And I'm frankly having a hard time understanding the policies. I mean, I get if you have more capital, but I mean, once you get to, well capitalized and you're running well and you can absorb losses, I mean, you're given a preferential treatment to those who just, happen to set aside more capital. So we're urging them to get rid of that. I mean, that makes a disparate treatment among really well-run banks. It just I'd like to see a better articulated policy reason why you're doing that. So we urge them to take a look at that. The operational risk component, I think Rebecca kind of covered that. I mean, we made the argument. I mean, the operational fees aren't fee generating. I mean, they're kind of your cost of doing business, and putting a capital charge on products that are otherwise low margin is a bit difficult as well. The defaulted exposures, Rebecca covered that as well. So not too much more to add there, other than we're urging for trade settlements greater than 90 days to carve out where the delay is for operational reasons and not for credit reasons. And even though articulating precisely what that means is a bit difficult, that's where we went. Likewise with the tenor of trade, I think Rebecca covered that as well. So it just, next steps is we're going to be engaging in a lot of advocacy with the agencies. During the last round, we set up meetings with all three agencies and had several of our banks come in, which was quite illuminating to them. ICC has been helpful about giving us data. You'll see in our comment letter, we use some of their data, particularly to show the low default rates on a lot of our products, and been working with the International Trade Organization for them to. I'm urging them to notice the effects of the capital rules on trade and hopefully to get them to weigh in. Maybe they will, maybe they won't. see, but we're certainly working that angle as well. And with that,
Thank you, Andy. That's great. Good. I think you did amazing work getting that all ready for the Fed. Thank you on behalf of the industry. We're going to swing to part 3. This is the banking practitioner review, the current state of Basel, how it impacts banks' transactional activity. Our speaker for this piece is Svetlana Phelan, a chief counsel of regulatory affairs and policy at PNC. She provides strategic advocacy and legal advice on a broad range of topics, including Basel III, capital rules, stress testing, liquidity, and other prudential regulations. And there are 8 questions pending in the Q&A. So we're going to get to those. Thank you all for posting those, and we will get to them as soon as Svetlana is finished.
Great, thank you. I must start with a disclaimer. I am at PNC Bank, but the views expressed here are my own and not those of the bank. So as Alice already mentioned, this has been an interesting process. It's been great to work with BAFT and other industry associations to provide comments. So I'll just cover a few points quickly. We have a good coverage already. I'm happy to engage in Q&A. But basically, the way I see this rulemakings, they are pretty consequential because they will have a lot of changes in a number of key areas. By changing risk weights and calibration for large banks and for smaller banks, these rules will basically affect how banks think about lending, credit, how much capital is available in each area. So, for example, Matt covered that there are, two proposed approaches: more expanded version for largest firms and standardized for other firms. And both stacks contain different incentives. Depending which swim lane you pick, so to speak, there will be different incentives, and this will affect trade finance and many other areas just based on how firms think about capital. So it's something definitely to watch out for. How these broader changes will trickle down to business lines and impact credit availability. Basically, the proposals also do make a lot of changes in in some of the areas we've seen for a long time. So, for example, we've seen risk weight updates for mortgages series, other areas, not pertinent per se to this topic, but just to say that there's much more granularity and risk sensitivity in the proposals, which we in general support. That said, it will require time to stand up new systems, implement controls, etc. So we and a lot of other banks have requested for more clarity on implementation. We can speculate about the final timing date, but in general, firms requested at least a 1 year implementation timeline after the final rule is published, because we anticipate there will be a burden associated with implementation. We, PNC, submitted our own letter. We've been active in a few other trade letters, but basically our comments evolve around commitments, as was already covered. We talked about a few other exposures where we think regulators should look to the underlying risk of the exposures rather than sort of like mechanical calibration. And really the idea is to avoid some cliff effects and to reduce volatility of capital requirements. So I'll pause. There's a high-level comments. If you want to talk about anything specific, just provide a question. Thank you.
Thank you so much, Svetlana. We have 9 questions in the queue, and I'm going to ask the panelists to be crisp in your responses so we can get to as many as we can in the time we have left. So the first question that was posed was, can you elaborate on what criteria apply to allow a bank to classify an unrated investment as investment grade, minimum requirements and evidence to be provided, and can it be opposed and reversed by the regulator?
I can take that one, Craig. So the bank has to design a system that takes into account factors other than collateral, that like they can't look to the fact that it's a secured loan as a basis to say that it is investment grade, which we strongly disagree with. But it generally is things that you would use for say your CECL reserve or for loan pricing. So issues like ability to repay, operations, cash flow, and the bank has the discretion to design its own criteria subject to the regulator second guessing it. I don't expect regulators to second guess individual determinations, but they might, again, if a bank has a scorecard that is incredibly overly optimistic, they might second guess it.
Thank you. Next question, I think, would go to Matt and Rebecca. It says, would it be fair to say that if the expansion of the commitment definition is adopted as the final rule, along with the 10% CCF above for SCF facilities where it's uncommitted and unconditionally cancelable and short term, this would be a double whammy where we go from 0 to 10% CCF on unused limits and 0 to 40% on lending commitment for a 90-day SCF facility. Is this interpretation correct? Rebecca, do you want to take a whack at that?
Well, I'm not sure about the 40%. Matt, would you be able to? I mean, certainly what we're saying is if the definition of commitment is on the expanded basis, there definitely would be the 10% set aside of capital for the uncommitted facility. I'm not sure how that impacts the 40% that's mentioned in the question.
So, okay. Next question.
Sorry. I said sorry, I was on mute.
Okay.
I think it would increase the it would be a double whammy because it would make some things that aren't commitments a commitment that is now in the 40% bucket. Hopefully most of them will stay in the 10% that Rebecca just mentioned, but some may go to 40.
Okay. Thank you. Next question. Can you please elaborate if the new definition applies to non-funded exposure of the bank?
Yes.
Okay. Next, for FRTB, while not so relevant for trade finance, it still has relevance for some of the other transactions beside transaction banking activities. Can you elaborate on key controversial items of the consultation that would diverge most from the proposed Basel FRTB framework?
Yeah, so it's the U.S. It would on one hand permit greater use of internal models by banks, which is a positive, but the larger negatives are some of the assumptions around what the default law, like what the exposure at default would be, or what the loss given default would be. Those are more punitive than Basel.
Thank you. Did I see that performance bonds would move to 50% CCF? EU and UK have retained this at 20. I believe Australia Industries is looking to request they reduce the 50 to 25. Did BAFT push for this to be retained at 20?
So right now, performance bonds are 50, and the regulators have proposed keeping them at 50. Andy, I don't know if you want to comment on what BAFT proposed and pushed on.
You're on mute, Andy.
We propose to move them all to 20.
Okay.
Not sure we'll get it, but we asked.
Yeah. Thank you. You touched on SCF programs in the first section of the presentation. Can you please clarify the capital requirements for the funded portion of an SCF program with invoices inside 90 days as it is today, and what is expected to be going forward?
Right now, that's 100%, and that with 100% risk weight, and going forward, it'll be 95%.
Thank you. What is the expected transition timeline for the new proposal?
The regulators want to have it finalized by the end of this year so that it becomes effective on January 1, 2028 without a further transition period. I think the more likely outcome, and I'd be interested particularly in Svetlana's thought on this, is that it gets finalized in February or March of 2027 and is effective in July 2028.
I like your first speculation better. Like January makes for a smoother timeline. That said, it cuts the timing. I think, especially for larger firms, there are so many things in play. There is GSIB surcharge, there is stress testing. So really, a lot of industry letters are about aligning all the requirements to make sure they make sense. And there are some brave banks out there who actually want early adoption. So we may see where regulators will go on accommodating that request, and we'll see where firms will come out.
Thank you. What is BAFT's position on maturity playing a role in defining trade finance commitments, especially for those running for longer than 1 year? Is there an official definition in the US for trade finance commitments like in the EU, which uses the wording, quote, are generally less than 1 year in maturity, unquote. However, in the EU, it is still largely interpreted to allow 20% CCF for TF instruments. Andy, Svetlana? Andy, you're on mute.
I might need some help on that. If Matt or Rebecca want to.
I think the goal is to simplify. It's like fewer buckets going forward, depending on 1 year mark. Yeah.
Yeah. I think they're going to get rid of it
Okay.
altogether.
Thank
The
you.
1 year.
Can you clarify whether the removal of credit insurance recognition is already final or still subject to change? To insured receivables, directly insured receivables, or purchase of insured receivables currently receive partial capital recognition for U.S. banks, and is the expectation that any reduction in recognition would apply only to the largest banks, or could it ultimately be extended more broadly?
So right now, only the largest banks have the partial recognition. The smaller banks don't have it. So there's nothing to reduce. And it is not final, but we're at 99% sure they're going to reduce it. The removal of credit insurance recognition, like 99.9%.
Okay. Any changes to crypto exposures for risk weights?
No.
If the new rules are decided upon by year end, will there be a delay in implementing the rules?
Yes, 1 year.
1 year. Back to the banks using their own internal rating methodology, would that also apply to the rating on subs, i.e. remove the need for external ratings for RWA weightings?
Yes.
Do ECA loan guarantees stay at a 0 RWA up to the amount of governmental guarantees?
Yes.
All right. Well, we have done them all. That's wonderful. Thank you very much. This has been a wonderful opportunity, and we've gathered this amount of talent to share with our industry. My huge thanks, BAFT's thanks to Matt and Rebecca and Svetlana and to my friend and colleague Andy. It's been a terrific experience. I'm going to turn it over to my colleague Jana Putina to do a wrap up for us. So we have 3 workshops coming up. We have the Trade Finance Workshop, that's virtual, September 22nd to 24th. October 6th and 7th is LC 101, also virtual. And we also have a Financial Crimes and Compliance Workshop, November 4 and 5. All of those workshops are virtual. And please scan the QR code to complete our survey of the webinar, and we learn a lot from this, so we would really appreciate you doing that. So thank you all very much. Huge thanks to our panelists. I hope that you found it worthwhile, and proceed. Have a good rest of the summer.